Hello and welcome to another episode of In Conversation With. This is season 3 of In Conversation With, which is seminars organized by CASI from New York. In these particular series, we invite senior professionals from across the world in search of executable advice. This particular seminar is on family offices. There are two parts to family office. Today is the first, tomorrow is the second and the final episode of family office. This promises to be an interesting session because we are talking to people who manage money for some very, very rich people and people from across the world. Before we begin, my name is Paresh. I am a member of the board of directors at CASI from New York. We are the world's largest peer-to-peer group for sustainability and CSR. We also run a very large volunteering platform with over 3 million volunteers. So, beginning for the day, before we go on to Simon to start with, I have a question. And anyone can answer this question. I would request a short answer, a 30-40 second, 1 minute answer to this. My question is, the concept of family offices, as started by Rothschilds or one of the large families in the US, was typically to manage the family money when the expenses of the family are so huge that they need to be managed together. And then that is how the concept evolved into family office, right? But today, we have so many multi-family offices offered by wealth management companies that it has become a really retail product. So, in terms of a family office, I can just do will management for somebody and call myself a family office. I can do, any one small thing for a family and say, okay, we are managing a multi-family office, or I can offer a part-time CFO service and say, okay, we are doing family office. So, what is really happening? Is the family office concept being diluted? Or there are so many families which have evolved and deserve family office service. How is it happening? What is the evolution there? So anyone, I would like to hear your thoughts to this.
Hi, can I jump in?
Sure.
So, hi, my name is Salil Thanawala here. I think family office as a concept, especially in India, is effectively becoming very pseudo to pure play wealth management. I think it is just construed as wealth management from the ultra rich. Now, because of that, I think there is a very lot of distinction between wealth management and family office. But family office as a concept is definitely much more larger, and I think that has got diluted over a period of time. People aren't focusing on the operating businesses. People aren't focusing on succession planning. It is very, liquid asset oriented.
Okay. Over to you, Simon. Let's hear your thoughts on family office. What's your angle? Mr. Simon?
Hi, thanks for the opportunity to join the conversation. So, my name is Simon Littlewood. I'm originally from the UK. I qualified as a lawyer and then an accountant, and then went into banking, and then after that went into private equity and fund management. So, I spent the last 25 years involved in management of funds, initially for institutions, and for the last 20 years for family office. And the bulk of that time has actually been investing in emerging market space. So I did some of the first funds for investing in China and Southeast Asia, and then into Eastern Europe, and most recently into Africa. So for me, my angle right now, where I think a lot of the opportunities and the threats are related to sustainability. So I think what we're seeing at the moment is a convergence of many different factors, most of which were accelerated by COVID. So we've seen some geopolitical things with a shift of wealth and a shift of manufacturing away from China into other emerging markets. That's particularly benefiting places like Vietnam, Indonesia, and increasingly Africa. Eastern Europe is also benefiting from that. We're seeing issues like sustainability becoming huge. The Europeans led that. Now the US is coming in. That's generating massive funds for investment into new technologies to address climate change, and at the same time penalizing a lot of traditional technologies, but also addressing the scientific fact that climate change is happening. It is going to impact things. It's going to impact whole economies. It'll impact a lot of assets. So if you're sitting on real estate on the coast, you're probably going to get very worried as the tides keep rising and insurance companies start withdrawing the insurance. So we're already seeing that in some of the coastal areas in the US. So as a family office, you've got to look at these shifting tides and decide which assets you're going to divest out from and where you're going to focus your wealth. And that's basically what we've been doing the last couple of years, advising our own family, the family office we work for, and some of the other investors as to the new areas and new technologies to go into, and which of the old assets to start disposing of as things change geopolitically and economically. So a quick summary of how we view things.
Mm-hmm. So, okay. Let me ask you this. You manage money from Hong Kong.
We're actually a global family office. So it's a third generation now. So we've got family members and assets and businesses scattered globally.
Okay. So I was talking to someone from Deloitte earlier. They're saying globally, the trend is the top three things are risk management, philanthropy, and legal. So the family offices, globally, large family offices, single family offices, their core mandate is to manage the risk, philanthropy, and the legal angle for across the companies, the wealth, and transition from one generation to another. So in your experience, what has been, what are the top three factors? Is this these three same factors or something else?
It depends on the family office, what generation it is. There's a huge difference between, say, a first generation family office and a third or fourth generation. The first generation tends to be run by the entrepreneur who made the money in the first place. He tends to be far more involved. And in many cases, he tends to focus the investment on the industry where they've got the most experience, where they understand what's going on, where they have the contacts, and where they can actively get involved in that value. Third generation, probably professional managers running the family office. They're looking to diversify risk, really avoid any kind of concentration. So, and quite often that's where the philanthropic comes in. The first generation tends to be the people that made the money, and they tend to be less generous. The third generation tend to have, particularly if they're younger people, they tend to have a philanthropic bent, and particularly in the sustainability space. What we see is that the older generation and the older family offices tend to focus on more traditional assets and traditional businesses, whereas the family offices that have been taken over by a younger generation are much more into sustainability and more interested in the philanthropic side, making sure that their investments make a difference rather than just make a return. So it's not one size fits all. It's very much you've got to look at the generations involved.
That's a very interesting angle. That's a very interesting angle in terms of linearity of time. So as time passes, then it shifts from one focus to another. I'm sure Amrish will have some questions, but we are let's have a look at your presentation, Simon.
Yeah, sure. We can. I don't know if you can put it on the screen or.
5 minutes उसने login किया फिर क्योंकि admit मैं नहीं करती, correct? Admit.
You will be able to share your screen. I've given you the rights.
I keep telling him, Derek, please turn your video on. Turn your video on.
Yeah, sorry, I can't do that, but I think it's essentially.
You want me to do it for you, Simon?
Yeah, if you can do that, that would be great.
Yeah, because see, Right. इसीलिए because see.
Yeah, sorry, that's not working.
ठीक है, done. I will do that. And also like because वो बच्चों की list आई है, मुझे
Yeah, you should be able to see it now.
Yeah, it's on. We are able to see that.
Yeah, if you can go on to the next slide. Okay, so these are basically the key things that we're focusing on. The first is sustainability, which is the main area where we're looking at, which is a shift of traditional assets over to new technologies, new businesses, and a big shift in wealth away from the older generation to a new generation who focuses much more on sustainability and the threats to the planet rather than the older generation. The other big theme which has come up with COVID is food and food insecurity. This is probably the area where at the moment we're committing most capital. The COVID caused huge disruption in the food sector, primarily because of logistics. So a lot of food producers were not able to export and move the stuff around, which meant they didn't have cash flow, which ultimately meant to the bankruptcy of the businesses. So we've actually been putting funds together and investing very heavily in the food sector in places like Africa, where they were quite badly hit from the lack of the export market. And they really need to upgrade a lot of their technology and have working capital to be able to start re-exporting and producing again. So with the rising price of food in places like China, some of the food products there have doubled since COVID started because of food shortages and these supply disruptions. And going forward, as food consumption rises in places like India and China and globally, the price of food and the supply of food is becoming an increasing issue. The rise of Africa is one of the other big themes that we work on. Africa's got 1.2 billion people. It's the fastest growing population on the planet. It's the fastest industrializing area in the world. A lot of the factories are beginning to shift there, but they're dealing with a relatively undeveloped infrastructure, particularly financial infrastructure. So what we're focusing on in Africa is putting the financial infrastructure in place to be able to deploy capital into this rising continent. There were some figures came out earlier today that they're anticipating around $2 billion worth of venture capital investment into Africa this year, which is a new record. But $2 billion for a continent of 1.2 billion people is nothing. It's a couple of deals in US terms. The other two points here lifted on the left are related the disruption caused by technology. A lot of what we've seen with COVID, what we were seeing before COVID, as technology starts replacing jobs and replaces traditional assets. So COVID accelerated that in things like the retail and logistics, where they would be forced to stay at home. But we're already seeing that in production. The factories that I've been to in the last 5 years, increasingly dominated by robots and mechanization with less and less people involved. What you do with all those hundreds of millions of people who used to work in factories and those jobs which are being replaced is the key going forward. And digitization is a part of that. We're heavily involved in digitization on the finance side. The fintech and digital technologies for the financing sector in emerging markets is a key way of moving things forward in places like Africa, where they don't have a lot of the traditional infrastructure. The other very big theme as well, which impacts what everybody's doing in the investment space, is the zero or negative interest rate environment. We have huge amounts of cash everywhere and more being printed every day, reducing interest rates to incredibly low levels that we haven't seen in generations, which is distorting investment. So you've got a stock market which is booming, you've got virtually free cash and people everywhere looking for deals and transactions. we're seeing the biggest problem that most investors have is what to do with their cash, because interest rates at this level are likely to be there for some time. The flip side of that is it's increasingly difficult for smaller companies and those in emerging markets to actually access capital. So in a world awash with cash, what we're seeing is it's getting harder and harder to find money for those smaller businesses, higher risk businesses in emerging markets. And going back to the point you made earlier, Paresh, on the regulatory side, that's actually becoming a key problem for a lot of investors. The regulations are getting tighter everywhere, whether it's KYC, anti-money laundering, or taxation regulations, or confirming that you're complying with sustainability rules. So the risks for investors are rising, and that's feeding back into the investment committees and the family offices who are saying, right, well, do we really want to invest in a country where we're not certain that it is ESG or impact? Because the reputational risk going forward outweighs the return we can get from the investment. So those are basically the key points. So I'm happy to pass on to the next person and discuss these as a panel.
No, that is. It was nice of you to make this presentation because I personally manage some money. I'm an advisor to 2 large families. I manage upwards. I'm just an advisor, not the fund manager, but I advise upwards of 9 billion US in India, which is a lot of money in India. But you are one of the rare family offices who has a dedication towards ESG or sustainability. So kudos to your clients. If you are dedicated to ESG or sustainability, being a family office, that's really nice. It's not only very cool, it's also also very futuristic, because ESG is the future.
I think I mean, I've been in the ESG space since the 1980s, before anybody knew what ESG was. And then it was really a charity thing. It was very difficult to make money when the cost of oil was low and the technology for ESG space was not very good or not very developed. Things are different now, with the regulations and the advances in technology. It's become a real sector and a real business where you can make money. So you're seeing a lot more money going into the space, which is then driving up valuations. So it is now a place where you can make money as well as do good.
Sure. Let's hear your thoughts, Michael, before we open it to the audience and for the question. Mr. Michael Siva from Sri Lanka.
Thanks, Professor Paresh. I share the same sentiments as Simon. I mean, of course, I would say like pre-COVID, a lot of asset classes we would have seen, having a very traditional approach. But a lot of, from my experience, I've seen there's a shift that's happening. A lot of interest is now towards towards like technology and agriculture and renewable energy. Those are like sectors I've seen family offices are now getting actively involved. Probably that's, I think, came about from the COVID pandemic, I guess.
Sure, absolutely, sir. So do you have a presentation for us?
Yes, I will take you through. Can I share this on screen? Or?
Please, Dr. Mitesh.
Yeah, I've given you the rights, Michael.
Okay. I think I've emailed you as well. Okay, let me see if I can share this. can you see this on screen?
Oh, yes.
First of all, thank you, CASI New York, and thank you, Professor Paresh, for this invitation. It's been an absolute pleasure to kind of join the forum and also like discuss and share insights with the fellow colleagues. Just to give a bit of background about myself, so I head the finance for a multifamily office based out of Singapore. We have predominantly our asset classes are based in Sri Lanka, and we have an investment mandate towards kind of focusing on South Asia and Southeast Asia. So I mean, like I've been thinking about this last couple of days, and I thought of sharing, looking at 4 sections basically. Firstly, to kind of give a bit of background on the family office dynamics in Sri Lanka. As you know, I've been like working closely, probably 5-6 years in Sri Lanka with my family office experience. So just to give a bit of background, right now in Sri Lanka, majority of the businesses are, I would say like significant products and services are coming out from family offices. And right now, in the current context, you would see like, from second generation to about, 4th generations managing these businesses. And there are some, renowned businesses with a history of more than 50 years. Yeah, to give a bit of history, probably some of the oldest family offices, started with tea, and then, second generation taking over with, expanding into different verticals, and, the third generations further expanding. Now, transforming them into larger corporations. So in terms of the 4 sections I was looking at is like, to give you a bit of background on the family office context in Sri Lanka, and then to actually look at the asset classes held by these family offices, probably pre-COVID, and also like, post-COVID, how this has changed, and also like to look at some of the challenges that came about from the COVID-19 itself. In terms of the asset classes, I think, as you know, previously, what we discussed, traditionally, just to give you a bit of background before we go into the asset classes, I think the important thing is to kind of understand the mindsets. So like previously my colleague told, the family office initially was started by the founders, then went into the second generation, and like then moved on to the third generation. So one important key consideration that is the mindset, when passing on from generation to generation, there is a bit of, I would say, like a cautious approach. So based on that, what we have seen in the past is, asset class predominantly based, we can categorize generally into like 3 categories. So we have seen like having a fixed income and cash. So that's the majority of the family offices where they use those money to kind of like in fixed deposits, treasury bills and treasury bonds, basically to cover their day-to-day expenses and do their philanthropic activities. And whenever they had like excess cash or I would say excess returns, the second preferred option obviously was to kind of invest in real estate. I would say like this is like typically like I would say like, since Sri Lanka is a developing country, still the mindset is towards that real estate seen as a some sort of safe form of investment. Thirdly, the private equity, that's the business itself, in sense like the families started the businesses and then brought it into a successful venture. So these 3 categories are the, in general, what we see, what we have seen probably pre-COVID in terms of, the asset classes. Obviously, I mean, like, last year was a challenging year. So I mean, with COVID, not only family businesses, I would say like corporations as individuals, it was I mean, like, it was a challenge to the status quo. And, I mean, I would say like, how it challenged kind of, the way we operate. So what I've looked at is like, when you look at the family office dynamic itself, like, how so I've looked at three considerations, or I would say like, the pain points and how they kind of impacted the family office dynamics. So basically, the three factors are like, cash flow, liquidity, and uncertainty. What I meant, I mean, like, when I say cash flow, for example, see, some of the changes that happened, for example, like I would say, like, if you look at the leisure industry, obviously, like, not only, I mean, like Sri Lanka, probably a few other countries as well, like, who, I mean, like, some of the family offices depend on, industries like hotels, restaurants, and probably tourism. So see, the normal, I mean, like status quo of, assuming you get these cash flows are now kind of challenged with lockdown, and probably I would say for the next 2 years or so, where there's a lot of uncertainty. So that cash flow was a key consideration. And also, like, second is the liquidity. See, one thing, I mean, like, traditionally taking that cautious approach of, having those asset classes was, for example, like, what we saw was, uh, family officers kind of, families investing heavily into real estate. Then, what they realized was, see, like, I mean, they couldn't cash out, or, then in the sense, like, couldn't, I mean, like, couldn't liquidate their real estate assets. Then the other consideration is uncertainty. So these businesses, like, they, I mean, like, they have been passed on from generation to generation. Like, there's no, I'm like, certain. Obviously, there are some family officers who have expanded into different verticals, but other than that, it's about, carrying or doing the same business. When the business model itself is kind of, challenged by the current pandemic, there's a lot of uncertainty. So these three considerations, I would say, I mean, like, not only caused a lot of challenge, but I mean, in my next slide, I'm actually going to talk about the new investment avenues. But also, I mean, like, these three considerations also brought about new investment opportunities, rather, So in my previously, I was talking about how leisure industry was affected, where family offices kind of, had to kind of shift, or, look at new industries. Likewise, there were, I mean, like, in a few other industries where I would say, like, for example, like Simon was saying, on there's a lot of demand on agriculture. Similarly, what we saw was, there were certain policies in Sri Lanka as well, like, government banning imports on agriculture or essential agri-produce. So then, and on the other hand, like, imports of, automobiles was, restricted for the next 2 years. So those, I mean, like, if you take like those family businesses relying on these industries have to kind of, look at new verticals, or new business opportunities. So, I mean, if you look at how these new opportunities, or, new in avenues, I mean, like, played a part in, changing these three key considerations. For example, like, now, if you look at cash flow, for example, I put diversification, like, looking at new industries, they have to kind of, look at new industries where they get basically, like, the wealth is kind of, preserved, or, new wealth is kind of, created. And also the other issue with liquidity, for example, like mainly like previously the what we have seen is like family offices having like private equity. Not many families have seen like in Sri Lanka investing into investment funds, or mainly because they prefer direct investments. And also like if you look at when it's like when the business is transferred from one generation to another, like the business secrets or the the salient points, or the strategies were passed on. It's a very closed kind of very secretive kind of model that was adapted. But what they realized from COVID was, you need liquidity. And also like from a government perspective, like they have a incentives to kind of family businesses look at listing, and also like look at IPOs, and also to kind of get into with the stock market, to increase or increase their liquidity. So that is one thing that happened in in the past couple of months. We are seeing a lot of family offices looking at IPOs, and trying to create more liquidity in terms of their asset classes. And also in terms of uncertainty, what we have seen is like the younger generation, like previously I would say the old man was the boss, or the old generations were dictating terms, and you see now the younger generations kind of stepping up and taking over the management with new ideas. But that's what I mean. That's what has been happening, I would say, like last year or so. I mean, in summary, I would say like the key takeaway is like as family office is and the biggest thing is to kind of be adaptive to the environment, and also like consider the consideration I mentioned, like cash flow, liquidity, and uncertainty. And whatever strategies, or whatever strategies they're doing, I mean, if they're able to manage these three, I would say like they have a greater a greater longevity, and also like also have a sustainable business going forward.
Is that the last slide? Can I ask you a question, Michael?
Yes, Professor Paresh.
Okay. No, that was an absolutely amazing discussion you shared, or thoughts you shared. Because if you are looking at cash flows from the businesses, and there are some businesses which are going down in terms of cash flow, and you are helping the clients, the family office clients, reach out in new businesses, then I'm sure you guys must be doing an amazing job. Because there are very few family offices who actually bother to go into the client's business, understand their cash flow, and help them look out for multiple avenues of cash flow. So, kudos to you guys. You're doing a good job. Now, before we go into the last speaker for the day, Salil Thanawala, I have a question again for Siva, Michael. What happens is direct private equity is cool. You are a multifamily office, you employ CFAs and finance specialists, and then you do direct private equity. It's doable. But what do multifamily offices do about risk management, or technology, or succession planning, or something as simple as concierge services? Do you employ people in-house for all this stuff, which would be very costly then? Or do you outsource these activities? Is this a pain point for a multifamily office?
Good question, Professor Paresh. I mean, like generally when it comes to like investments and the legal, we do, I mean, like have an in-house team. And like you said, the important thing is to kind of manage risks. and also like, while also making sure you get the returns as well. So like I said, last year, with COVID, a lot of changes. Uh, we can see a lot of changes. Even our existing portfolio, we saw like, pre-COVID, I would say like, leisure was one of the sectors that we are kind of, heavily depending on. But like with COVID, things have changed. But what I would say is like, when you have a balanced portfolio, when you're able to kind of, identify opportunities, and also have a portfolio. It depends on different families, but when you have that uh, diversification in your portfolio, I think you would be able to kind of, overcome, whatever the challenges that are presented.
Thank you. Thank you, Michael. Over to you, Salil ji. Mr. Salil Thanawala from Edelweiss, please tell us your opinion. What's your angle?
So, thank you everyone for having a patient hearing throughout. I think just to give you a little perspective of India as well. See, India is a very closed economy, and currency movement from India to outside India is very very restrictive. So we aren't a very convertible economy in the way Hong Kong or Singapore or London and New York or Japan would be. So because of that, India is a very inward-looking economy, and that makes it very difficult for domestic family offices to kind of look at very exotic instruments, because the solutions that are available in India are very very restrictive. So, and because of that, I think the ecosystem around family offices in India is very, very nascent. I think it would have actually taken up speed only in the past few years. Yet the concept of a few family offices have been existing since more than a decade or a decade and a half. But I think the awareness of it, the institutional nature of it, is actually starting to be told to people, or becoming aware to people, just very recently. I know enough of clients that we cater to who are, billionaires in their own right, are managing companies with, probably $10 billion worth of market cap, but don't have the mindset to set up a family office ecosystem for themselves. And we're dealing with large amounts of capital here. So I'll just take you through a little bit about the journey with focus on India, and then we can take the conversation forward from there. So is this Zoom? Yeah. So I think India is very, very, like I said, very, very nascent. So people get classified in just three buckets, whether it's completely in-house, a mesh structure where they focus on just getting solutions from outside, or just completely outsource their wealth management to a third-party, outfit. For in global terms, would probably be a Goldman or a JP Morgan or a Credit Suisse, and at India, Edelweiss is be kind of one of them. So it is yet very wealth management focused, and there are a few factors which I think are definitely creating issues for that growth. Uh, India is not as developed in terms of global markets, in especially for the regulatory aspect, the governance aspect, and that kind of brings a lot of principal agent problem, whether you keep people in house or you keeping people as an engagement policy from an external agency. So that creates a big issue for having a sustainable engagement for any family office who is not per se family. I think that kind of an ecosystem problem is very difficult to resolve, and but I think it will be possible to do with a little bit more regulatory interference, and more regulatory structure in India, and that can happen if we can learn a little bit from the developed markets. Like I said, family offices are yet just thinking only wealth management, and not the way Simon was talking about, in terms of how do the businesses are going to evolve, what themes are going to be 10, 15, 20 years down the line. They aren't thinking of it from that point of view. And the setup is very very so-called retailish in nature, which means that they aren't giving institutional decision making powers to the family office teams that are on board. The patriarch of the family yet continues to make all the decisions. The next generations also feels a little bit stifled. So I think having powers as a non-family member becomes very very a rare instance in India. I think I can count maybe not more than 20 families in India which will actually give powers to their family office who are not family people. So I think that will be a big issue in India to actually set up the ecosystem well. I think the way one thing can actually grow if you want to have a family office set up in India is to have a little bit more broad-based structure and think about all the needs of the family. And I'll touch upon that in the next slide as well. So I'll skip this part. I think the regulatory environment, the enforcement of any fraud or mis-selling or litigation is actually takes inordinate amount of time. So that ecosystem prevents actually scale up of money in the institutional setup, which is one of the reasons why a lot of people are actually moving money outside India in the limited capacity that you're allowed to try and take global exposures and move money to more better jurisdictions, so to speak. Uh, because we are such a large population, right? There are dime a dozen advisors available on the street, and that makes it very, very difficult to differentiate between quality of advice and how do you compensate for it. So India is kind of very, very known for expecting free service. Yeah, we are a service-driven economy, but yet the value of service is very difficult to actually put in play here. The way you have as a product is very difficult to say that this is a particular price for a product, but in service is very difficult to value it. So because there are a lot of people over here, and there are a lot of people who are providing these services, like at the start of the conversation we did mention that it is becoming diamond dozen available. So I think that is a problem which India is facing, and the culture is not allowing it to become more institutional in nature and a multifaceted engagement process, which you can talk about, multi ways in which you can add value to the family. I think ownership of the advice which actually comes in terms of decision making as well is a major problem. There's a lot of friends and family who kind of advise, and a lot of friends and family which kind of give information, give opportunities, and just go away and drift away, and they don't take ownership of that. And unfortunately, because of this principal agent problem, a lot of emphasis is given on that advice, and that becomes very difficult to kind of get out of in the future. You do park money with it, or you do make collaborative investments, but then at the time of exit, I think people aren't holding hands the way they did at the time of entry. So that becomes a little bit of a problematic situation for domestic families. I think we touched upon this in the other two conversations, but I think India, like I said, is not thinking about in outside the wealth management domain. But the way we've kind of built our business here is we actually wear three hats. We wear the hat of an investment banker, wear the hat of a wealth advisor, and the health and the hat of a corporate banker. And lastly, we kind of play a slightly a lesser fiddle as a family confident consigliere, the way you would like to call it, from Godfather terms, that they want to take advice of how do they actually move power from one generation to the other. I think India after independence has been 70 years, so we are kind of in the second decade of intergenerational transfer of wealth. So that makes it very, very important for the succession planning to actually play the role. And what we do focus a lot on is how do the companies, the operating assets that the companies actually own, how are they moving from how are they aligning themselves for the next 15, 20 years. The companies as a whole, they do look up at it from the form of ESG and all the sustainability point of views. But when effectively it comes to taking a contradictory call for their personal assets for where things are not ESG compliant, I think most families in India would not actually bat an eyelid to skip that. Uh, so very few people are actually focusing on that. But I think as a piece, India is not very highly leveraged as an economy. So that makes it a little bit of a problem for family offices per se to take advantage of leverage and act upon things the way you see in probably a Singapore, Hong Kong, or New York or Japan, where money is so easily available and leverage is a part of life. Leverage in India is considered very, very taboo, and most people would frown upon actually taking leverage within the group as well. So none of the family offices, more often than not, will actually take leverage because their mandate would be only preservation of capital, and they consider leverage as such a risk that they would actually not touch upon it at all. So with hopefully with India opens up a little bit more in terms of their economy and convertibility of their currency, I think the leverage will definitely be something that will be useful, where because money flow will become very smooth, and actually people can consider leverage and the cost of debt can actually come down. I think we did touch upon risk management, and there are the few vectors which I think people are focusing upon their risk, of how they want to look at the risk, and very few institutional families are actually considering it from that way. I think people is a very important risk which people don't take cognizance of, as the people who are taking decisions within the family office. I think to keep them on board for a longer period of time is a challenge, because people can keep job hopping here and there, and that becomes difficult where the ownership of the decision does not actually go through seamlessly. So the assumptions which were taken for decisions at that point of time kind of just fizzle away, because documentation of all these things is not in black and white. Indians don't believe in black and white documentation so easily. I think a lot of it is more word of mouth, and because of that, the risk of forgetting the decision and the rationale for the decision is very high. I think governance is a big problem where everybody in the family office, if you're not the family, or in some cases, even if you are the family, trying to get few drops of water out of the entire lake for would you say for personal pleasure, so to speak, unfortunately is a very very active concept in India. So creating an entire governance ecosystem and ensuring the right decisions are taken, the right spirit for the owners of the capital is actually something which people need to focus on. A little bit on the asset side, of course, price risk is something which people look at. We focus in terms of drawdowns, because the concept of VAR is something most people don't understand in India in terms of actionable. So we just think that, okay, look at it from the point of drawdowns, because India is a volatile equity market. Liquidity is very very sporadic in India. You don't get liquidity in the cases where black swan events were to happen. I think in the COVID time, where Indian equity is actually corrected by 40%, liquidity had just completely washed out the window. Equity, you actually had liquidity, but in the credit markets, of course, the liquidity just completely washed away. Even if families are not taking funding or leverage, they are exposed to ALM. I think the previous speaker also spoke about the fact that there's a large amount of expense that these families have. So the commitments of these families vis-a-vis where the money is allocated in terms of locked-in solutions, business operating businesses don't have liquidity, is a major challenge. I think in terms of ALM also, what happens is people do end up focusing. India actually does not give up equity ownership, so you end up taking leverage only at the holding company to invest back into the business, and that entire ecosystem is the only place where leverage is kind of acceptable. And the ALM on that, where the operating business is cyclical, but the interest payouts are actually more regular, is a big problem for domestic families. And I don't think people actually think about it from that point of view, while creating structures around which, and they actually tend to end up losing their businesses. With the IBC code coming into India, that is the bankruptcy code which came into India about a couple of years back. I think a lot of promoters have actually started to lose their operating companies, their family jewels, and the crown jewels in that. So I think ALM is a risk which most people do not actually focus on, but people just believe that it is only meant for banks. But it is applicable for a family office as well. Again, credit is a risk which Indian families do not actually consider as much, because they don't invest in credit, because the overall structure in India is not that solid for reporting transparency. I think people don't trust the fact that investing in credit is actually a meaningful avenue to look at, because when you immediately go down to small cap companies which are probably $500 million or less, transparency, genuinity of the numbers becomes a little bit of a challenge. So credit is a market, I think, is restricted to larger institutional players and larger family offices. But unfortunately, what happens is credit in the peer set ecosystem is so loosely given that, and without proper documentation, that enforcement of that in case your peer set business goes for a toss is a big risk. And the way you'd like to say, okay, I know someone, and okay, he'll not default, I'm giving him probably 100 million, and he will return it when the business comes back. But what if the business does not come back, and you do not land up having any enforcement documentation for it. I think that's a huge risk Indian families actually face, and they don't have the mindset to actually solve it. I discussed about currency a little bit a while back, where because convertibility is a problem, people are definitely transferring a large amount of capital out. I think on an average, about $2 billion of assets are actually moving out of India every month from the larger families. Of course, it has sporadic movements on that, but on average, about 1.5 billion to 2 billion is moving out to geographies like the Middle East, Singapore, Hong Kong, and London. And that is purely because people want to be considered now global citizens, de-risk their India risk. They are having next generations trying to settle abroad. And that creates a problem for them because convertibility of rupee is a problem. So once you become a certain size, very few families want to have all their eggs in the Indian currency as a risk management tool. So I think that is I think that end of what I had to say. I was asked to be brief.
Thank you very much, Salil bhai, for this nice presentation. You were very direct on the upsides and the downsides of Indian family offices. I am sure that would be of interest to all the viewers and the other participants. For the benefit of all, I would like to introduce Usha ji. Usha ji, are you here? She's from batch of 78. I am Ahmedabad. Your founder Salil, your founder Rasesh ji is batch of 1978. I am Ahmedabad.
Wonderful.
And Usha ji, works with a lot of rich families. She is a finance professional. So I thought this would be an apt time to introduce Usha ji and ask if she has any questions.
Hi, good evening, Usha ji. How are you? I believe she would have had some network issues or dropped off.
So because she had some questions for the family offices. No worries, we have time for 2-3 questions. Anyone? Simon, Amar, Subodhji? Anyone questions for any of the speakers?
So, Simon, if you don't mind, I'd like to ask you a question.
Yeah,
So when you're looking at Africa and the fragmentation of Africa, the way it is, and the lack of laws, enforcement of laws there, when you're looking to park capital, these kind of jurisdictions, what sort of measures do you all actually take as a family to mitigate that risk?
the key thing is we look at the people involved. So it's the personalities and the people that are driving the business, which has always been how we've made investment decisions in emerging markets and places where they don't necessarily have strong legal systems. So we basically back people. Businesses change, environments change, regulations change. But if you're backing people that are basically honest and have the intention to give you your money back, that's much stronger than having a regulatory system or a good legal agreement. We spent 20 years investing in China, and when we started in China, there was no legal system at all. So it was very much based on getting to know the people and making sure that you continue to add value, which is another key factor. So when we invest in businesses, we only invest where we see that we can add value to that business and help them grow the business, instead of just putting money in and then phoning them up every month and saying, when are you going to give me my money back?
Simon, I was hoping that you start investing in India also.
India is such a big place that we've shied away from it just because it's so much of an effort. There's so much work to be done to find the relationships and do the work. So it took us about 10 years to get to know China, and I don't have another 10 years of work to look at India.
That is putting it very subtly.
I'll leave it to younger people.
Do we have any other questions, please?
So I had one particular question. So just understand from the perspective of a family offices. So when you go about advising any family for investing in a particular startup, so how what is the process like? How do you go about it, and how do you identify the startup to invest in from that perspective? Because I come from a startup ecosystem, so just wanted to understand from the perspective of a family office.
I think, I mean, we've been involved in a lot of incubator programs and startup programs around the world over the years. For us, the key thing is being able to understand the business and being able to add value to it. Because if we understand what the company is doing and we know that we can help them and guide them and introduce them to customers or management teams, that significantly reduces the risk. If it's a business we don't understand, then generally speaking, we don't touch it. Even if it looks very good on paper, if we don't understand it, we don't touch it.
Okay.
I think there's one more thing I'd like to add on to it. I think that is, any patent or technology that is kind of being, scaled up in the form of a business model. I think that is something which most people will look out for. I think what Simon said, I completely agree with that. It has to be synergistic to the business. But I would like to say that technology is definitely something which most people are keen on looking at.
Got it. Understood. Definitely makes sense. And thank you so much, everyone, for the insightful session. It was a great, lovely session. Thank you.
Ushaji, good to have you back. If you have a question, please let us know.
No questions, Paresh, but overall very, very interesting and diversified kind of presentations. Sorry, I dialed in a bit late though.
No problem. Always a pleasure to have you with us, Ushaji. With that, we come to the end of our session. We have a part 2 of family offices tomorrow, where we have Patrick from California, Lisa from South Africa, and Mayank from India, talking about what's their angle. Thank you all very much. Thank you very much. Thank you.
Thank you.
Thank you.
Thank you.